So we are now live. We'll see if we can keep our respective dogs under control. I gave mine a bath a little while ago, so he's feeling a little better. But he's decided to lay down under the chair here, and hopefully he will stay there.
And hopefully mine will
So
stay quiet. So
yeah. So
they're both
anyway, yeah. Well, so welcome to the stream here. I'm Ed Parrott with Keller Williams Realty here in Knoxville, and my guest today is Lisa Stepp. She is with Mpire Financial here in Knoxville, and I have asked Lisa to tell us all about how we can get a little lower rate on our mortgages using the buy down option. And there are several different options available, apparently. So we're just going to turn it over to Lisa now and let her walk us through it.
okay. So Ed, if we want to bring up the little PowerPoint here. So one of the great ways as interest rates have crept up to keep the real estate industry moving is the use of buy downs. And there's temporary buy downs and there's also permanent buy downs. And basically, how does it work? Um, the seller of a property can pay any fees or concession in order to select any of the buy downs. And what a lender will do is they'll have loan level price adjustments, or also known in short as LLPA, to cover the cost of this buy down. Um, and there's also a lender paid option. We have that option right now for a free 1 year buy down for any sellers that are listing their property, and if they need a new mortgage, we can actually give them a free 1 year buy down. And basically how it works is we just are going to use seller concessions that comes in terms of points, and we'll be able to show you as we work through the slide deck kind of how that appears and where it appears on the documents. But buy downs, the 4 different options, is a great opportunity to reduce the interest rate for whatever buy down option that you select. And I've got some,
Okay.
and here we go. Um, I can't figure out how to go backwards because I got the little present button in the way. Okay, so we got to go back. So talked about how it works, and the benefits is just really to help sellers get a property sold without affecting the sales price. We always recommend to sellers, work with our realtor partners. Hey, if you think you're going to go in and take a price reduction, don't take the price reduction, but update MLS to say, hey, this seller would provide X amount of dollars to any buyer for a buy down option. And then everybody wins, the house gets sold, the buyer's got a better rate, and all the benefits go directly to the borrower. And if there's any excess concessions, we can use part of that money for a buy down as well. And it really allows them to have a lower interest rate anywhere from 1 to 3 years, lowering the payment, but the borrower must get approved at the current note rate. Borrowers, can have that monthly savings. And the intent and thoughts are, if you do take like a 3-2-1 buy down, which is, every year the rate adjusts by 1 point, starts with 3% off the 2%, 1%, that the rates would be lower enough to allow for like a permanent refinance to a lower rate. But no one's got that crystal ball and no one can really detect when and if interest rates would come down into what magnitude would benefit a borrower to go ahead and refinance. And when we use buy downs and there is a lower payment, it helps people with some payment shock. If they're a first time home buyer, maybe been living with parents, now they got to pay for a mortgage. You can kind of ease into that a little bit as well. So from our lenders, every lender can offer some different things, but they're for purchases only. You cannot do a buy down on a refinance. All the different products that are available, conventional, all the government government programs, FHA, VA, and even jumbo loans. Conventional programs allow for both primary and second homes. FHA and VA only allow on primary homes. No USDA is available for buy down options. And there's actually 4 different buy down options. The one that I like that generates the most savings, but also the priciest, is the 3-2-1 buy down. And we're going to talk specifically and show you examples of what this buy down looks like. We have the 3-2-1, which is my favorite, a 2-1 buy down, a 1-1 buy down, and a 1-0 buy down. And here it shows what happens in the years. So the 3-2-1 buy down, year 1, you have a 3% savings. If we're using a note rate today is 7%. So a 3-2-1 that first year would be all the way down to a 4%. And then the 2-1, it's 2% lower in year 1 and 2. A 1-1 is just 2 years at 1% lower than the note rate. And then a 1-0 is just 1 year to have a 1%. And that is actually the cheapest. And that is the one that we can grab for free for all of our sellers out there if they're selling their home and looking for a new mortgage.
So now this, sorry to interrupt you here, but this lender paid option, then the 1-0 buy down, is available at no cost for sellers only. What about for a buyer that's come?
All the offers kind of change regularly. So if there's a way to stick a buyer in there, absolutely, we're going to stick them in too.
Okay. Would that 1-0 lender paid option typically be available for a buyer only?
Yes.
That was not listing.
Yeah.
Okay.
Yeah. Yep.
All right.
Okay. So, and then here we have an example of kind of what the mortgage statement would look like. We have with always interest rate, or it shows always the principal, how much interest is being paid, if there's any money coming in for taxes and insurance. And then the credit is the actual buy down. The buy down money goes back to the servicer and it gets credited every single month throughout the buy down period. And it just always shows like the total amount due. But you'll always have that, and you'll always be able to see your buy down. And I know we have it later in the slides, but let's say if someone enters into a 3-2-1 buy down, they get transferred, they're selling their home, mortgage is going to get paid off. That money is never lost. It sits in an escrow account. It's pulled out monthly to make the payment, to provide the discount for the borrower. And in the event that mortgage is paid off, it just goes to the principal reduction. So there's never any worry about losing anything.
Okay, so just so I'm clear on what you're explaining to us there, whatever fee the buy down cost initially goes into the escrow account, and that in this example here, you've got it's the $407 a month would come out to pay toward the mortgage. But if say circumstances intervened and they wound up having to move after 10 months because somebody died in the family or whatever,
right,
then that other $800 would be there to either pay toward the principal or toward a new purchase.
That's correct. Yeah, that money is never lost. Okay.
Okay.
So there's never any worries there. Okay. All right. So here's an example of the 3-2-1 buy down. So we're using a loan amount today of $350,000 with an interest rate of 7%. And that principal and interest payment, we're not including any escrows here because we want to show the true savings. That mortgage note rate payment is $2,328.56. So if we go after a 3-2-1 buy down, year 1, we take 3% off the note rate of 7%. So year 1 is 4%. And we can see the note rate and what the buy down payment would be. Year 1, it's a $657 savings monthly for almost $8,000 savings annually. Year 2, we're 2% lower or 5%. That payment jumps up to $1,878. It's still a $449 savings from the note rate, and yearly savings is almost $5,400. In year 3, we're just 1% off the 7% at 6%, with a total payment of $2,098, which is a $230 savings. And we're just shy of $3,000 in the annual savings. And you can see 7, 8, 9, 10, 11, 12.
So the total savings there over the 3-year term then is about, just with my mental arithmetic, about $15,800. Whatever error I might have had.
Yeah, $16,000.
Okay, so there you go. So my question then is, so you're saving $16,000 now in a 3-2-1. I understood that either the seller is going to have to give some concession to buy this down, or the buyer would have to buy it down, or maybe some combination of the two.
Or a combination of the two.
With the $16,000 savings, is that what the buy down costs? So does the buy down equal what the cost is up front?
No.
Okay.
The buy down's typically less than what the total annual.
So we're saving $16,000, and in this example, just a wild rough ballpark guess,
$14,000, $15,000.
Okay, now I was going to guess maybe $15,000. So
yeah.
Okay.
Yep. So and then when we look at buy downs, depending on the borrower, depending on if it's seller paid, if it's part of the purchase offer, we can equate it to, and I didn't use that example because it'd be very specific and it can be overwhelming to actually look at the cost. So it's based on that specific transaction and that borrower's financial picture, et cetera. But we can look at what percentage would cost a seller to give this to their potential buyer. And then we can look at what would be the pricing adjustment if the buyer was just doing that themselves. So those percentages and loan level pricing adjustments, if you're not in the mortgage industry, they can look a little overwhelming. But the lenders just really spell it out to us. And it, we have lenders all the time that will throw out some special. If it typically costs X, we may get a special for the month it's significantly less. So, we just, we're just always on top of what our lenders are offering, and then just pass that information along to our clients and our business partners that we work with. And here is the 2-1 example. Again, we're going to use the same loan amount of $350,000 and an interest rate of 7%. We have the same payment, $23.28. So a 2-1 example is 2% off the initial note rate year 1, which been 5%. The buy down payment is $1,878, and that's a $449 savings and roughly $5,400 annual savings. Year 2 is 6%. And drops the payment by $230, and that savings is almost $2,800. Okay, and then that slide don't look too good. We have our 1-1 buy down, which covers 2 years, but we're just going to take 1 point off the initial note rate, which would be 6%, and you can see we're saving the $230, and the annual savings is almost $2,800. So it was like $5,000-6,000 total. What is that total? $5,523 over the 2 years. Okay. And then our last example we have is our 1-0 buy down, and this is the one I can grab for free right now because it's a special that's being ran out there. So we take 1% off the initial note rate, which is the 7%, but with borrowers, I know we've mentioned it earlier, everyone has to qualify at the 7% rate. That's when we go into underwriting, we have the rate locked, et cetera. Everybody has to use the note rate. But again, it's the almost $2,800 savings. Who wouldn't want $2,800 savings over the course of their first year if it didn't cost them anything? And then here's just our legal disclaimer. APR is typically 7.3%. Everything is subject to borrower approval, and it's a full 30-year term. and we've got estimated finance charges of $5,600 out there. So that's just our little disclaimer.
Okay.
But on a seller paid temporary buy down, because there's two options. It can be seller paid, lender paid, or the buyer themselves can, you know, say, hey,
Do the buy
how
down.
much is the buy down? The borrower, the benefits are we can use any seller concessions that's part of the contract to take the buy down fee. I would engage in conversation, look at both options for my borrowers, and make sure we know when they're getting ready to write their offer if they do want that offer to include that. And here's the note that if during the option, if they do have a buy down, now they have to pay off their mortgage early because they're relocating again. The non-dispersed and available buy down funds will be credited to the unpaid principal balance of the mortgage. And the buy down charge is auto calculated as a temporary rate buy down fee, and that is shown in section H on both the LE and the CD. So everything, all those charges are disclosed on the LE and CD. And here's the example, one example of the temporary buy down fee, and it happened to be seller paid, and it's $12,336 that the seller paid for the borrower for that buy down. Just an example of how it looks on our financial documents. Okay. Now, a lender paid temporary rate buy down, typically, here's an example of the loan level pricing adjustments. And we have it in here, but it gets really confusing. But that just shows you the 321, which is the biggest savings, is the most expensive, then the 2111 and the 10, which is a loan level price adjustment of 0.875. Typically, if you don't work in the mortgage industry and when you price out loans, there's a lot of different factors, and that is a factor in determining rate, fees, etc.
Okay.
Okay.
Now, I'm well known for asking unusual questions. I'll put it that way. You had a slide in there for a 1-1 buy down.
Yes.
And I got to thinking when that popped up, will they do a 1-1-1 buy down instead of a 3-2-1, or would there be any real advantage to doing that?
Yeah, have not.
These
I've never
are
seen
kind
that
of fixed in stone here. Huh?
These are kind of fixed in stone, and you can see if someone's going after an 8 to 15 year term, you can see that the buy downs are actually cheaper. The first slide here, which 4.5 loan level pricing adjustment on the 3-2-1, that's for a 30-year government and jumbo. And then you can see significant savings if you drop down to an 8 to 15 year fix. Those are a little bit cheaper buy down.
That would really save them some money because they're paying off quicker and paying less interest in the long run anyway.
And yes. Yep. So I love buy downs. And unfortunately, I don't see a lot of people taking advantage of them.
Now, just so I can straighten my own thinking out here, on the 3-2-1 buy down there, you got a 3.75 LLPA. So I'm assuming that that's $3,750 per $100,000 of loan. Am I correct in assuming that? Or
no, it's not necessarily, because depending on the situation, which would be very specific to the borrower, where they're buying, what their FICO score is, there's so many other factors that come in. So some of it will wash out depending upon that borrower's situation. So when we look at, say our base price is 7%, but hey, they're only going to put 10% down, then there'll be another loan level pricing adjustment for that. Maybe they have a large loan amount. Maybe the lender has, hey, that bucket is going to give them back a whole point. So it's the total price of the transaction. So that's why, it's not just 3.75. There could be some other credits out there that would reduce that, because there's so many other factors that come into pricing a loan where the lender says, hey, if you have this FICO, if this is your loan amount, if this is your loan to value, here's your par pricing, here's all the loan level pricing adjustments that come in, how many, are positive or negative. And that's why the computers do most of the work because you can have 6, 7, 8 different adjustments for one rate.
You're not near as old as I am, but I do not know how on earth we got by without computers.
I know.
We did it, but I don't know how.
Well, and I get a daily rate sheet from most of the lenders that I do business with, and they're 16, 17, 18 pages long. Because there's just so many different factors that go into, determining rate. There's so many pieces of information from that specific transaction, including state. If you want to buy short-term rentals in Pigeon Forge, most lenders out there have a surcharge or a loan level pricing adjustment just because you're located in Sevier County.
Yeah, Sevier County is definitely the more pricey county around here. That's for sure.
Yeah. But they're gorgeous. So.
Yeah. Well, no doubt about it. But,
yeah.
So on the buy down program, we've been talking primarily about the temporary buy downs. Now, you did mention at the beginning that there are permanent buy downs as well.
There is permanent buy downs, but they're not all lenders offer them. That's why I didn't really put anything out there. Most of them are just the temporary. Because when we get into a permanent buy down, the borrower would absolutely pay points to take the lower interest rate. And again, there's no loan level pricing adjustment that I could show on a permanent buy down because it's based on that very specific transaction. But when you do take a buy down, there are additional documents that will be in your disclosure package, and it's going to just spell everything out. What is the buy down? What's the savings? And that's going to be a document that you sign at closing. So it's a great opportunity. If you are, out there searching for your new home, if you do, in the hunt for a mortgage, ask your mortgage professional, hey, how much does a buy down cost? What are the interest rates? And, it just helps a great deal of people. I just don't know why more people just don't take advantage of it.
Well, I'm going to inquire and see who wants to save a little money. I'm sure we can find a person or two that would like to save some. I do want to dig into the permanent buy down just a little bit more if I could. The permanent buy down, is it usually just 1%, or can you do a permanent buy down at 2%, or?
Because the permanent buy down becomes rate specific. So let's say interest rates today are 7. You're like, hey, I want a permanent buy down. I want to make sure I get an interest rate of 6.
Okay.
It could cost you 3 points. It could cost you 1.5 points. It just depends on what the market condition is and what the rates are for that specific day.
Okay, so on a permanent buy down, then the borrower specifies what rate they are wanting to achieve, and then when they lock in, whatever the rate is at that point is what they will determine what they have to pay in the way of points to get the permanent buy down.
Right.
Okay. And I'm assuming permanent buy down is available for both the 15 and a 30-year mortgage.
Oh yeah, absolutely. Any mortgage up there. Yeah, because the permanent buy down is just you're actually going to pay to have that lower note rate permanently. So a lot of people, they can get a little pricey. Like ARMs were real big back in the day, and they're still out there. Because that's a whole other conversation. But the savings on ARMs isn't so much greater than your fixed 15, 20, 25, 30-year mortgage. So that's why.
And for those that aren't in the industry, ARM is adjustable rate mortgage.
Right. Yes.
And I'm thinking, of course, I'm no economist, but it's my opinion that I wouldn't say all the ARMs, but there were a lot of ARMs out there in the 08 timeframe. and there were a lot of subprime loans out there in the '08 timeframe, and a lot of subprime loans were in fact adjustable rate. And all that little storm come together, and we had the little crash of '08. So
Yes.
it was a medium-sized crash. I'll put it that way.
Yeah.
But I don't think we're anywhere near where we were back in '08. Number one,
No.
the delinquency rate right now is at a record low. And
Right.
you're not going to have foreclosures if you don't have delinquencies. Now, I do notice that credit card debt is going up, however. So,
And so
that could spill
refinances.
over, but people are going to pay their mortgage. If they're smart, they're going to pay their mortgage first because they don't
Right.
want to wind up out losing their home and then having to rent. So,
Right.
Now also, and I don't mean to hold you too long here, but I'm a talker, so when I get going,
You're good.
you mentioned that the USDA loan does not have any buy downs available.
That's
Is
correct.
the USDA typically a lower rate to begin with, however?
No, it's just a rural program. It's property specific, and it allows for 100% financing.
Mm-hmm.
So
Okay.
the USDA is just a whole different animal to begin with.
Mm-hmm. Okay. Well, that I think covers the questions I had about it. I appreciate you letting me get a little education here. I'm not trying to be a mortgage professional because heaven knows I got my hands full with the real estate I've got to do or the forms I got to do on my end for selling real estate. But that's why we got attorneys and we got mortgage folks and we got title companies. So it takes a pretty good team to get it done.
Small village to get these, get these homes to the closing table. Yeah.
Okay. Well, we made it through without any dog activity. Mine's still under the desk here sleeping. I hope yours are too.
Yeah, I've got one right here. My Bernese mountain dog is laying right here, and she is sleeping. She's usually not the loud one. It's my two little ones, my Frenchie.
Yeah. Well, I gave Sebastian a bath a little earlier, and he doesn't like getting a bath while he's getting it, but he feels good after it's over. So, yeah, he's under there sleeping now. So that's about the size of it. So we'll think of something else to talk about in a week or so, and get back on here.
Okay.
All right.
All right. Ed, you have a great weekend, and I'll talk to you soon.
Thanks.
You're welcome. All right. Bye-bye.